Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex language of corporate filings to uncover the real story behind the numbers. Today, we're diving into a recent report from Momentus Inc, and let's just say things got a little interesting with their debt. So, what exactly is Momentus up to? Well, this filing of Form 8K is essentially a report on significant events that shareholders should know about. Think of it as a company's official news flash to the public. It is not a regular financial report like a 10Q or 10K, but it does highlight important changes, and today's big news is all about a new agreement, or more precisely, an old agreement getting a makeover. Back on the 30th of June of last year, Momentus took out a convertible promissory note. Now, what is a convertible promissory note? Think of it as a loan, but with a twist. The lender, in this case AGP Alliance Global Partners, has the option to convert that loan into shares of the company's stock. Instead of just getting their money back with interest, it's a way for companies to get funding without immediately giving up equity. Originally, this loan was for $500,000, and because of a stock split, meaning they reduced the number of shares outstanding while keeping the total value the same, the conversion price was set at a little over $29 per share. Fast forward to the 9th of January 2026, Momentus decided to swap that original note for a new one with the same partner, AGP Alliance Global Partners. This new note is also for $500,000, but here is where it gets interesting. The conversion price has been drastically reduced to a flat $10 per share. This filing also touches upon the company's financial instruments like common stock and warrants. Remember, warrants are like options, giving the holder the right to buy stock at a certain price in the future. The fact that these are listed suggests that the company is actively managing its capital structure, and these instruments are part of the financial landscape that investors need to consider. Now, why is this exchange of notes a big deal, and why is it filed as a material definitive agreement? Well, changing the terms of a significant debt agreement, especially the conversion price, can have a big impact. A lower conversion price means that if the company's stock price goes above $10, AGP Alliance Global Partners can convert their $500,000 loan into a much larger number of shares than they could have previously. This could potentially dilute the ownership stake of existing shareholders. It also signals that the company might be facing different financial conditions or strategic objectives compared to when the original note was issued. This specific item concerning financial obligations or off-balance sheet arrangements is directly tied to the new note. It means this isn't just a minor adjustment, it is a new financial commitment or a change to an existing one that impacts the company's balance sheet. It creates a direct financial obligation for Momentus. The very next part talks about unregistered sales of equity securities, and it links back to that note exchange. The issuance of this new note in exchange for the old one was done under an exemption from the usual registration requirements of the Securities Act. This exemption, Section 3, a 9 of the Act, generally applies when a company exchanges one of its own securities for another of its own securities. It means they did not have to go through the lengthy and costly process of registering this exchange with the Securities and Exchange Commission, or SEC, because it was a direct exchange between the company and the note holder. And that brings us to the exhibits. The most important one here is Exhibit 10.1, which is the actual text of this new unsecured convertible promissory note. This is where all the nitty-gritty details are laid out. While we don't have the full document to pour over here, knowing it is filed means the company is being transparent about the terms of this agreement. Finally, we have the signature section dated the 12th of January 2026. This is where Lon Ensler, the Chief Financial Officer, has signed off on this report, confirming that the information provided is accurate to the best of their knowledge. It's a formal sign-off that makes the report official. So, what does all of this really mean for Momentus? On the surface, it looks like they've managed to renegotiate a debt instrument to their advantage, lowering the conversion price on a $500,000 convertible note. This could be seen as a positive step in managing their capital. However, it also highlights a few key points. First, the company is actively using and modifying convertible debt as a financing tool. Second, the significant drop in the conversion price could suggest either a more favorable position for the lender, or perhaps the company believes its stock price is poised for significant growth, making the lower conversion price a less risky proposition for them. It also points to a need to manage potential dilution for existing shareholders. Momentus is in a dynamic space, and its ability to manage its financial obligations while pursuing its growth strategy will be crucial for its future success. We need to watch how this plays out, especially if the company's stock price rises significantly. Alright, that is our breakdown of Momentus Incorporated's latest filing. What is your take on this debt renegotiation and what it signals for the company's future? Do you think this is a smart move or a concerning one? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And don't forget to subscribe for more deep dives into corporate secrets. And as always, check out the link in the description to join our Discord community where we discuss these filings and more. Thanks for watching, and we'll see you in the next one.